video I'm going to give you a very short introduction to the very basics of preference shares. So let's start with the very basic ideas. What actually is a preference share? And the best way to think of preference shares is kind of a hybrid between debt and equity. They're shares, so they're like an equity in a company, but they're also like debt because the company has an obligation to pay a fixed sum to you. And the reason that they're called preference is because you get your dividend first. You have preference over the other shareholders. If you don't get your dividend, nobody does. You're top of the pile for dividends, which has a lot of advantages if you're relying on income. If you're retired and you have to get so much each year, you don't want to have lots of common stocks that don't actually pay a dividend. Where the board decides this year we're not paying a dividend, whereas in preference shares you don't have that problem. However, your dividend is fixed. Usually when you read the name of a preference share, it'll say some percentage in its title, and that's what you get. So if the company doubles its profits, your dividend is exactly the same. So over time, your dividend will be worth less due to inflation, unless you're adding to your holdings constantly. And normally they have no voting rights, so you're not really a member of the company. You're not, in a sense, an owner in the same way that a common stockholder is. The two big ideas, probably the most important consideration, is whether it is a cumulative preference share or a non-cumulative preference share. So cumulative preference shares means that missed dividends must be paid. So if the company has a bad year or a bad half year and decides not to pay the dividend then, it owes you that money. That becomes a liability to the company. They have to make that up at some point in the future if the company continues to go on. And they cannot pay any dividends to the normal shareholders until you've got your missed dividend and your next dividend. Whereas non-cumulative means dividends can be missed and not paid at all, but if you don't get your dividend, common shareholders still don't get the dividend. And non-cumulative preference shares come with what's called a risk premium. That essentially means that the risk of not paying is reflected in the price. If you're very dependent on income, you probably want to look more at cumulative preference shares because you can feel a bit more relaxed about those. But if you can pick the right non-cumulative preference shares, your rate of return will be slightly higher, but of course you're taking on more risk, so that's not at all surprising. You also have to consider redemption of preference shares. They can be bought back by the company if sometimes they're called callable or redeemable. You'll usually see some sort of date on them, like you could have like Bellaway has got, the building company, has got 2014 preference shares. That means at some point in 2014, on a date, they'll be able to buy all those shares off you. Irredeemable or perpetuals can't be bought off you. For example, Aviva has a load of perpetuals, so they can't be bought off you. So you buy those and you will always get that preference dividend as long as the company exists. And one thing that people often don't realise when they first look into these is companies can't actually buy preference shares back in the open market. So if you were to sell your shares and the company decided it was buying these back to get rid of it to lower its debts, then it could buy them back, but just off the stock exchange. So they can't buy them if you don't want to sell them. And yield to maturity is what you want to be calculating when you're looking at redeemable preference shares, because you can buy them under the nominal value. So you could buy them for 80 pence when they're worth £1. So when they're bought back, you'd get that extra 20 pence, which would give you a very good rate of return. Whereas more importantly, if they're trading above the nominal value, when they're bought back, that will be kind of a loss. So you want to work out what your yield to maturity is, adding up all of the dividends that you'll get from it, and then taking the amount of money that you'll get when they're bought back and comparing that with the price you've paid. So give you your yield to maturity, which is a better indication of what your long-term rate of return will be. And preference shares have a nominal value, which is what they pay the interest on, just like you would with bonds. If you know about par value, it's very much the same idea. Normally preference shares have a nominal value of £1. They trade around £1. If they're more than £1, you're paying slightly over the nominal value. If they're under £1, you're paying less than the nominal value. And they only pay the kind of interest on £1. So just start with an example. If you look at the Aviva shares I mentioned earlier, it says 8.75. Remember, this is cumulative, so they can't miss dividends. If they do, they owe you. The IRR is irredeemable preference shares, and the nominal value is £1. Right? And they trade at £1.15, but they're only paying 8.75 pence. You usually read this percentage, just put a pence after it. If the nominal value is 1, percentage and pence can be thought of as the same thing. And since it trades 115p, you're paying 15 pence above the nominal value. You're not actually getting the 8.75, you're getting 7.6%, which is less than that. But if you were lucky enough to be able to buy them for under £1, this particular preference share has it several times in its history traded significantly below the nominal value, then you would be getting even more than 8.75%, which you'd be very happy with. So that's the very basics of preference shares. Hopefully that's equipped you with enough information and go and start looking at them and working out how they fit into your portfolio, or if in fact they do at all.